Hello, everyone. I'm Victor Kroeger, and welcome to the MNP Fall 2022 Agricultural Industry Webinar. As we are continuing to cope, or pretending to cope, with COVID-19, the world is starting to resemble more of the pre-pandemic life. However, the war in Ukraine, unfortunately, continues to wage on with no apparent end in sight. In addition to the terrible loss of life on both sides, the displacement of millions of people, and the massive destruction of infrastructure and homes, the war is responsible for inflation that has necessitated rising interest rates. These have affected all aspects of the economy, and as John will discuss, the agriculture industry has not been spared the effects. I am a Senior Vice President of MNP Ltd., the insolvency and restructuring arm of MNP LLP. As previously mentioned in prior webinars, MNP LLP is one of Canada's largest professional services firms with offices across the country. We have specialized client services groups that we call niches, each with dedicated employees working in them. This allows us to be able to provide our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches, and those niches, or the number of niches, are growing. Agriculture is our largest and oldest niche, dating back to 1958 when the firm was established. As the agriculture niche is so large, it is further broken down into sub-niches, including food and manufacturing, intensive livestock, primary producers, Hutterites, cannabis, and farm income programs. MNP is also the only professional services firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agricultural farming backgrounds and bring a high level of technical expertise, firsthand knowledge, and close relationship with the agriculture industry to give us a real understanding of the issues faced by today's agricultural industry. The FMC group supports all of our other service lines in any ag-related engagement, and in particular in every agricultural insolvency or restructuring, where they provide us with expert advice to a specific situation and, if necessary, to be hands-on in a formal engagement. John Loeppky from our Winnipeg office and part of our farm management consulting group will again provide his insights into Canada's ag industry. John is a professional agrologist who has close to 20 years experience providing services to the agricultural industry, starting as an ag lender and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as needed. Our webinar again has been pre-recorded to allow you to watch it on your time. At the end of the presentation, you will find contact information for both John and myself for any questions you may have. We will respond to these questions as quickly as we can with answers. John, the floor is yours.
Thanks so much, Vic. So starting off today, we'll just kind of go through a little bit of the agenda, kind of what we're going to talk about, some of the topics we're going to touch on. So on the first slide here, yeah, just looking at, some of the market fundamentals. We'll talk a little bit about, some policies that are in Canada and maybe a little bit on the trade side, and then kind of run through some of our major commodity groups that we see in Canada here. So just to start off, we'll talk a little bit about some of the market fundamentals that affect agriculture. And, so probably the biggest one is just when we have to talk about supply and demand. And especially in agriculture, demand seems to I guess, change a little bit on a slower pace. Supply is usually something that tends to jump around a little bit more on. A crop example is probably a great one where, certain times of the year we're looking at, the US to see what supply might look like on certain crops. Other times of the year, we're looking at the other side of the equator, maybe down in South America. So depending on, outlooks for supply, has an impact on pricing, has an impact on, potentially what other commodities guys might be planting instead of maybe what they planted last year. So it's a fairly dynamic, I guess, fundamental in the agriculture side, and it's constantly changing. So just because it was something last year doesn't mean it's the same issue this year. So and the other piece that we always like to talk about is trade. I will say that in the past we've seen more of a globalization, if you want to call it that, where as commodity producers, everyone was looking for lowest cost of production, and sometimes or lots of times that stretched outside of national borders, and with shipping rates maybe fairly reasonable, then we were seeing products produced maybe around the world that we were competing with here in Canada. So lately I think that trend has started to maybe go the other way a little bit. Food security is a word that we're seeing more and more. And so we're seeing that being more of a driver sometimes than just a race to the lowest cost of production. So ultimately driven by consumer demand at some point, but interesting just to see that shift, and one of the outcomes that have come out of COVID, I guess. And since we're talking about Canada, we do have to touch on supply management. Kind of unique in a lot of ways to Canadian agriculture, where we're trying to match supply with demand. It's not always perfect. In fact, most of the time it's not 100%, but definitely trying to limit supply to match that demand side, which has its pros and cons. And we see it lots usually when we're talking trade with other countries. They're trying to dismantle that because as much as we're controlling supply, we're also in our national boundaries, we're also putting big tariffs on other product coming into Canada, so as a way of keeping that product out. So I think just to start off with, probably start a little bit with interest rates, just because it's affecting all the different commodity groups and obviously Canadians at large. So I don't think I really have to spend too much time showing where interest rates have been and where they're at currently. That's probably some pretty common knowledge. But I will touch on the fact that given the length of time that interest rates were historically quite low, I think what we've seen is lots of farms have been built on low interest rates, and that's been the standard operating procedure for lots of farms over the last couple of years. That's what they've been accustomed to. That's what they've kind of grown used to. When they're looking at income and expenses, that interest rate side has been pretty minimal. And then obviously in the last while here, we've seen interest rates spike up significantly. And I think it's catching obviously lots of farmers unaware, and it's changing just their ability to borrow to a certain extent, their ability to expand, ability to replace ongoing buildings and equipment, that sort of thing. So I think in general, we didn't see everyone just on a floating rate in the farm landscape in Canada. So the impact's going to be probably drawn out over time, but we're definitely already starting to see some impacts of rising interest rates, and we'll go through that in some of the different commodity groups. But I think that it's just goes without saying that the landscape has changed, and farmers are adjusting to it, and so there will be some impacts in how they run their business, some of the management decisions that they're making. And so I thought I'd throw together just a little bit of an illustration. And really what I'm trying to show here is, the impact of the rising interest rate, obviously one, and then a little bit of an example of, well, if we're going to do a restructure on a loan and potentially look at stretching the amortization, is that actually going to have an effect farm finances, and what degree is that effect actually going to be. So, you know, in this illustration, we just put a $6 million loan at 3.5%, which is kind of, you know, a bit of an average of what we would have seen maybe this time last year. And, you know, over 15 years, your monthly payments about, you know, 43,000, annual payments 515,000. And that's that first column. You know, if we jump to that third column where we just show the impact of that rising interest rate going up by 3% to 6.5%, and you know, maybe that's a little outdated already. Maybe it should be higher than that. But obviously you can see big impact to the cash flow of a farm, right? Monthly payment up significantly. Annual payments are up by over 100,000, right? So big impact from that standpoint. And so I wouldn't doubt that there's going to be a few, or maybe more than a few, scenarios where lenders are seeing that impact. You know, margins and cash flows might be tight already on the farm before interest rates went up. So you might have some clients coming in going, man, I'm renewing into a higher interest rate. This is really impacting my cash flow. Well, you know, one of the tools in the toolbox of a lender might be to stretch out amortization, right? So you're going to maybe, that's that middle column where you're going to stretch the loan from 15 years to 20 years. And interestingly, and this is kind of the illustration here, is that even when you do that, payments are still going up. So even though you know, you're doing something fairly major like stretching out that amortization by 5 years, interest rates have just increased that much, that quickly, that it's superseding kind of that benefit that you're trying to achieve there. So you know, probably not an uncommon scenario that we're going to see, and probably some of you have already been dealing with some of that already. So you know, just want to touch on exchange rates a little bit. You know, the red is US versus Canada, and green is EU. Obviously, lots of trade happens between the US. Commodity prices are usually set in US dollars, and some inputs, equipment, that sort of thing, definitely is all affected by the US exchange rate. So that's why we always throw it in here, just as a bit of a heads up on that. So as you can see, over 2022 here, we're seeing the Canadian dollar weaken and weaken, and in the last couple of months more so. So you know, it's if you're selling commodity into the US, that's a good thing. On the other side, if you're buying some inputs, your dollar's just not going to go as far, and that's going to cost you more. So just an interesting look at that. And normally we don't talk about the EU, the euro, but a little bit of, you know, interesting scenario here in that the EU is, or the euro is actually weakening on versus the US side there. So we haven't seen that in a long time. So I thought that was just interesting to note. And more we're starting to see some of our larger farms potentially looking at importing equipment from Europe and in euros. So with this weakening of the euro, we might see that trend kind of increasing, because there is definitely a price discrepancy between Canadian and European prices on the equipment side. So you know, it goes without saying, we probably need to touch on inflation as well, as it's kind of a little bit tied into the interest rate discussion there. You know, long term, here's a little bit what we've seen on the inflation side, right? It's been fairly steady, and you know, Bank of Canada does try and keep it in that 3% kind of range. I think that's roughly what they like to target. And then obviously over the last little while here, we're seeing inflation increasing rapidly, and obviously as a result of that, the Bank of Canada is working on increasing interest rates to try and combat that and get that inflation rate kind of back down to that 3%. So you know, with inflation still running fairly high, and maybe I'll switch to the next slide here. You know, we're definitely seeing that there's still room, I think, for the Bank of Canada to keep raising rates, to keep pushing that inflation down. But obviously lots of pressure, I think, from Canadians to kind of go, is it effective? Is rising interest rates really having the impact that that the Bank of Canada is hoping, which is to reduce inflation? I think, you know, maybe some housing, we've seen some impacts there, but obviously it's still running quite a bit higher than the Bank of Canada would like. So I'm not an economist, so I won't speculate on necessarily what the Bank of Canada is going to do next, but just looking at it, it does seem as though there is lots of room for the Bank of Canada to keep increasing rates if that's their only tool they want to use to push inflation down. So next, maybe we'll start looking at you know, internally some government policies and some of the changes that are going on there. You know, a big sort of safety net to a certain extent, or support mechanism that the Canadian government uses is this suite of products, which is their business risk management programs, including ag stability, ag invest, ag insurance, ag recovery, and the APP, that advanced payment program. So you know, if your farmers out there aren't currently using them, definitely you know, great business risk management tools, and usually used in conjunction potentially with some private insurance products as well. Healthy balance sheets, good working capital, right? Those are all good business risk management tools that farmers have at their fingertips. So you know, under the current suite of products, ag stability has seen a change recently. You know, where if their production margin decreases more than 30% due to, you know, a production loss, increased costs, or in market conditions, the government will compensate them if they signed up for ag stability. So, and that compensation has increased recently from 70 to 80%. So good news on that front. On the Agri Invest side, there's some new regulations now that if your net sales are over $1 million for any farm, you now have to complete an ag environmental risk assessment in order to receive the government matching portion of the Ag Invest. That's coming in 2025, so not here yet, but something on the horizon. And there's also this new resistant ag landscapes program. Not, you know, a ton of details on it just yet, but the goal is to push money into the ag landscape to incentivize development and implementation of carbon emission reducing practices. So, you know, I think next slide, we're going to talk a little bit more about that. So, you know, probably these fertilizer consultations are probably a big issue for Canadian farmers at this point. You know, Ag and Ag Food Canada released a document on those emission reduction goals for fertilizer application, and you know, it caused quite a bit of stir in the ag community, and I think you know, in the general Canadian news as well. Government came out looking at a 30% emission reduction target based on 2020 levels, you know, for fertilizer usage, and wanted to complete those targets by 2030. So, you know, some of those key practices are you know, the 4 R's, which is the right source, the right time, the right rate, and the right place. And also looking at using manure, compost, and digestates versus synthetic fertilizers. So, you know, and we'll talk about fertilizer prices a little bit later on, but definitely got the eye of farmers when this news came out. And, you know, from our perspective, you know, we saw lots of objections related, you know, to the timing, right? The time frame of 2030, also the dollars, right? The investment that would be required for new technologies and strategies. And so I think the industry in general pushed back on the approach and was looking for development of more of a strategic approach, using good science and good data to actually collect information and measure emissions. So at this point it stands that they've collected feedback from farmers, from public, that ended in August 31st of this year, and they're working on what that framework's going to look like going forward. So we don't kind of have any news on that front, but it's we're seeing other countries kind of in that same area. I know the Netherlands is looking at just reducing the number of farms in general that they have. So it seems to be certain countries are taking these strategic approaches in Canada, in particular, in the fertilizer area, that are impacting farmers in a large way. So starting off on some of the commodity updates, we're going to start with poultry first. I think avian influenza is probably the biggest news that we're seeing in the poultry industry across Canada right now. And in general, I think we're looking for some stability in the industry outside of that, this new disease, and profitability should looks like it's going to be a mix of improving prices and consumption, but countered by some rising feed costs. So here's kind of where it stands today on the avian influenza front. This is updated as of November 3rd. So, I'm sure the numbers have changed by the time you're going to be hearing and reading this presentation. But at this point, anyways, we've got 95 infected premises currently in Canada and 106 that were infected. Probably a more important number is just the number of birds, which is, hovering in that 3.5 million range. And to put it in context, right, there's about 153 million birds in Canada, and that's, including all types of feathers, turkeys, chickens, broilers, hatching, all those different sectors. But, it is a big impact to the industry. It might be a little bit smaller right now, but I know that it has the potential to really be a big impact, because when a farm does contract the disease, the CFIA does come in and they do take the flock out 100%. So there's compensation for poultry farmers when that happens, but it does impact their business to a large extent. And I know that it's been in Canada once before, or a few times, and it does have a big impact, because the protocol is just to totally shut the farm down, and actually it's a radius around the infected farm, and so the impact is pretty large. I know that there is some private insurance out there for disasters such as this, so producers can look at paying the premium and getting additional insurance if they choose. So just a little bit of anecdotal from the last time we had a major outbreak of avian influenza, I guess, and that was 2015. So what could happen? Speculation, obviously, but if the impact is big enough, right? We did see that spike in U.S. egg prices because they were shipping more eggs into Canada, and that was a direct result of avian influenza wiping out a bunch of egg farmers here in Canada. So and so the U.S. has the disease as well. So this can go back and forth to a certain extent on which country is impacted more. So if all of a sudden there's maybe a little bit of more impact in the U.S. and at that time the Canadian industry is less impacted, maybe there's an opportunity to export a few more eggs, in this example, down to the U.S. So, but just thought that was interesting how the U.S. price was affected by avian influenza outbreak in Canada in 2015. So, I think when we look at production, we saw a drop off in production during COVID. And that was obviously, I talked about supply demand. So demand had kind of reduced to a certain extent and supply chains were readjusting. So we did see in the poultry side that some production was scaled back. Producers couldn't totally fill quota. But I think we've seen that kind of all come off and producers are back kind of their pre-pandemic levels or even a little bit higher than that. Good news for the industry, it still remains the number one meat consumed in Canada. And I think, part of that also is that next point there that, chicken prices, for example, have risen at a slower pace than beef and pork, over the last 10 years. So, and we're seeing that a lot more, I'd say, in the last couple of months than ever before. So, bodes well for demand if you're a good protein source and you're also a little cheaper when consumers are going to the grocery store. So moving to the next commodity or industry is dairy. You'll hear me say this a few times, over the year we're seeing rising feed costs, and in dairy it is a big part of their expenses. So they are getting impacted from that as well. We'll talk a little bit about consumer demand and what's going on the dairy side, and then talk a little bit about kind of that support price. So I think we're seeing feed costs continuing to rise. Two things, right? Obviously, your purchase feed that you're buying into your farm is driven by higher commodity prices. Not only in Canada, higher commodity prices, but a lot of the ingredients that go into dairy feed are coming from outside of Canada. So, global inflation has impacted all those other countries as well. So those commodity prices are impacted as well for those ingredients that are being imported into Canada. And of course, then, your homegrown feed, whether it's silage or alfalfa, those costs are also getting driven higher just by inflation here in Canada with higher fertilizer, fuel, labor costs, just to name a few. So we're seeing a real squeeze on margins, and a large part of it is feed, obviously other items as well. But the price increases that we're going to talk about in a few slides here, while they're nice, they are always lagging, so that they don't always keep up with the cost increases. And especially in times like this where we're seeing, cost increases go up rapidly, farmers are having to pay for those costs today, and the increase in their milk price is lagging, usually 6 to 12 months behind. So it's definitely impacting operating lines, working capital, all those things. So definitely margins are getting compressed as a result of that. If we look at demand, this is year over year on July 2022. Looks like at one point, I think when I was doing these presentations, there was lots of negatives. Demand for milk products was definitely down. But nice to see that, when we're looking year over year, for most of the categories anyways, demand is up. We're in the positive range, and in some cases we're up, significantly. Fluid cream, kind of up 4.4%. So, I think part of that is just that restaurants and food service establishments are getting back to normal-ish. I wouldn't say pre-pandemic, but they're definitely normalizing. People are eating out more, and I think that's causing demand to go up to a large degree. So talking about milk prices just a little bit, February we saw an increase of 8.5%. September, recently there was another 2.5% milk price increase, and then more recently they've announced the February price increase of 2.2%. Those are all based on costs of 2021, normalized to a certain extent 6 months into 2022. So like I said, there's always that lag that happens, but we are starting to see those increases from earlier in the year hitting milk checks, and so we're starting to see those prices or those milk checks increasing. Unfortunately, though, it is a result of increased costs. So efficiency really is something that every dairy farmer has to be concerned about right now, because there is that lag and there is that margin compression. So efficiency is definitely something that should have been working on before that, but I think it's becoming more and more highlighted as we're seeing this big inflationary period. And just a little touch here on quota values and how it relates back to interest rates. Just interesting to see, in general, we were seeing quota prices in the West here anyways going up and up. That blue line is 2020, the orange line is 2021, the dark blue line is this year. So you can see that trend was higher and higher every year over the last little while here. And then concurrent kind of with interest rate increases, we're seeing, the quota values come down. Data here is till July. If we would extend it out to August, September, October, we'd see that trend continuing where that quota value in the West here is decreasing. So, much like the Bank of Canada is increasing interest rates to maybe fight some inflationary pressures. One of the impacts obviously is that dairy farmers are willing to pay less for quota. So just thought that was an interesting slide, and obviously we'll see where that future goes, but definitely impacts lending values to a certain extent, depending on how leveraged the farm is and how much they're using quota as security to secure their loans. So you might be seeing some of that come across your desk, whether you're using a 12-month rolling or if you're using a month-to-month quota value. So moving on to the next commodity, we're going to look at the crop sector here in Canada. Obviously, we got to talk about Ukraine, as Vic mentioned at the beginning. We'll take a look at how 2022 harvest has gone, and then touch a little bit on some farm equipment values, or purchases, I should say, and also look at some farmland values. So I think first we're going to start off talking about the Russia-Ukraine agreement. There's a few pieces to that, but grain obviously was a part of that, and so they were looking at opening up the port there, obviously, and the expectation was that 22 million tons of Ukrainian grains would be able to get shipped out and exported around the world. And a little bit of a hiccup as we went through that. I think they had agreed to opening it up. Then I think there was some bombings in the war. Russia reneged on the agreement, and interestingly, we saw wheat prices jump up by 50 cents immediately as a result of that. And then Russia backed off on that and agreed to the agreement again. And what do you know, wheat prices came back down as soon as that news came out. So, but you can see just, that top slide on the right there, what historical grain exports have been in the Ukraine versus kind of after the war here or during the war, what's been happening. So obviously big decrease, and that's been a bit of a driver on grain prices in general. So also there's been Russia exports a bunch of ag commodities as well, or items that are used in producing ag commodities. So there's been some easing of sanctions on grain and fertilizer, and that was agreed to with the United States and the EU. So I think on the import side, there's been sanctions on ag machinery and parts, seed, vet supplies, and some plant protection herbicides and insecticides, that sort of thing. So it definitely has impacted Russia as well. On the import side, they're having a harder time growing the crop. So and obviously, if you can't get plant protection, then even if you're growing a crop, your yields are potentially impacted. So, and I think they import roughly about a third of their plant protection products from China and the EU. So, yeah, so lots of different things going on in that part of the world that are impacting us over here. So, I'm sure that continues to kind of change, and every day there's some new news coming out of it, and the market reacts accordingly. So, something to follow, because it definitely impacts Canadian producers at the end of the day. So, but this agreement between Russia and Ukraine, definitely is going to help alleviate some of that rising food insecurity and global hunger. And if things do get back to normal, the intention would be, or the impact likely would be, that we'll see some decrease in commodity prices. So kind of like I talked about at the beginning, right? Supply and demand. So if Russia's taken some supply off of the global market by not allowing Ukraine to export, then that kind of jacks up prices a bit. And conversely, if they allow them to export, then prices will react accordingly. I want to talk a little bit about natural gas. It's important because it is the main ingredient used to make fertilizer. So, again, in kind of that same area with Ukraine and Russia, and that conflict, Russia's reduced flows of natural gas to Europe, causing some real uncertainty over supply levels. And that tightening supply has forced a spike in natural gas prices. And the ripple effect has been that there's been some production cuts in the fertilizer side. So, EU countries have been buying larger quantities of natural gas from US, given that Russia's kind of cutting them off. And I think that obviously is boding well for the US side. But, on the graph there, you can just show how much more it's costing the EU countries this year versus historical years, due to Russia cutting them off. So, and just talking about that fertilizer price a bit, estimates out there that production's about 400,000 to 500,000 metric tons lower per month due to some of these shutdowns that are happening as a result of natural gas prices spiking up and availability becoming limited. How does that impact Canadian farmers? Well, at the end of the day, we do put a lot of synthetic fertilizer on crops, and so we could see crop margins potentially impacted if all of a sudden we're seeing a bigger surge in fertilizer prices. We were at historical highs for part of the year, but they're starting to come off a bit, and we'll see if that trend continues. I know this time of year, everyone's probably looking at pre-buying to a certain extent their fertilizer for next year's crop. So it's nice to see they're coming off a bit. Remains to be seen, though, if that trend continues or if they spike back up. So looking a little bit at how harvest went, we'll start off in the US just because they do tend to sway the market. If they have a big crop, prices tend to go down a bit. If they have a smaller crop, then prices tend to go up. So, I think it's been a little bit droughty, if I can put it that way, down in the US this year. And we're seeing that in that, there's only 13.9 billion bushels that are forecast for their corn harvest, which is lower than it has been in the last couple of years. Soybeans, kind of running about average. They planted more this year, which is kind of, I think, increasing some of the overall output. So I know yields to a certain extent were down in the US this year. So and in general, I think world stocks are pretty tight. They were already pretty tight before this Russia-Ukraine conflict was happening, and I think nothing really has changed much there. So we're not seeing a lot of news out there that grain prices should fall off drastically. The supply is still pretty tight. Demand is staying steady. So there's none of the fundamentals, anyways, that are are showing that grain prices are gonna fall off a cliff here anytime soon. You know, and if we look a little bit more here in Canada, you know, parts of the prairies, we had some really wet seeding conditions to the point where, you know, with certain producers missed crop insurance deadlines. But I think, you know, harvest was for the most part uneventful. Some areas did experience some rains. If we look over to the east, they were a little bit the reverse of last year. You know, the west was dry and they had, I think, good moisture. This year was a little the opposite, where the west was better moisture, and the east, I think, was probably hoping for a little bit more at certain times of the year. So, so we're seeing kind of yields are a bit down in eastern Canada, up in western Canada. So here's some early estimates, anyways. You know, canola had a pretty good year. They're up, you know, almost 39%. Beans are kind of flat, up a little bit. Wheat was significantly up, you know, over 55%. Corn again was kind of flat, I think, with some of the higher fertilizer prices and some of the later harvest, or pardon me, later seeding. We saw less acres going into corn, but as you can see, lots was made up in oats. Big oat crop out there in Canada this year. I think conditions were good for it, so yields and acres were both up, which contributed to a huge oat crop for Canada this year. But worth mentioning that, you know, in the world stage, Canadian production really doesn't sway prices too much. Canola would be maybe the only one, but for the rest of the commodities, we really don't impact the world price or for that matter, local prices too much. So looking at machinery, we always like to, you know, look at the machinery trends, just because it does seem to be an early signal of farmer sentiment. Farmers are buying more equipment. They feel like, you know, they've got some good financial security, good financial health. When we see sales go down, they're being a little bit more cautious and waiting to see what happens on their operations. I will say maybe a little asterisk on this one. Part of what's going on in the industry is just getting equipment is becoming harder and harder. Lead times are longer and longer. So some of the downturn could be farmer sentiment, could also be that the supply chain is struggling to keep up with demand. So as we're coming out of COVID, I know we're still dealing with some of those impacts. So anyways, two-wheel drive tractors are, you know, down about 14%. Four-wheel drives are also down 10%. Combine sales are kind of flat, up a little bit. So so interesting that you know, also could be an impact of rising interest rates, similar to what we saw in the quota side. So definitely, I think it would be safe to say interest rates are impacting how much equipment farmers are buying, but remains to be seen, I guess. And we'll take a little quick look at farmland values. You know, FCC does provide a mid-year update, and that's that first column there from January to June. That's 6 months, and then the next column is the change year over year. So, you know, some major big increases across Canada, right? 8% over the last 6 months and 13% if we're looking at it year over year. So, so some really big increases. You know, a lot of times land values are probably determined a bit by grain prices and interest rates. I'd say those are the two biggest factors that go into what's driving land prices. So with good yields in the West anyways, and some fairly decent crop prices, I don't see land values coming off unless we see interest rates, I think, coming up a lot more than that. So yeah, so just interesting just to take a look and see, you know, in the last, or pardon me, the first 6 months of the year even, there's some double-digit increases in Ontario and Quebec and PEI, for example. So land values are still increasing at a very strong rate. Moving on to hogs, I think outlook for hogs is still positive. Although in the next slide, I'll kind of indicate, margins are shrinking a bit this year. And then another disease, right? That African swine fever is still out there, and it's not going away. So we'll touch on that a little bit as well. So thought it would be interesting just to kind of, based out in Winnipeg, throw up a little slide here on Manitoba fair to finish operations, just looking at gross margin, right? And you can see that trend. Obviously, prices have increased and are holding steady here over this year, but definitely expenses have risen with it. And as I've said before in other livestock slides, feed is a big part of that. So we're definitely seeing margins getting shrunk a bit. And I think it's gonna be a little bit tighter for hog producers. Just your margin especially that's a gross margin, right? So you still have a lot of other expenses to pay out of that yet. So it'll be interesting. Just where guys have our example here is based on cash. So if guys have contracted pigs or locked in some of their feed, those numbers could change, obviously. So. But just interesting to see that market is kind of still experiencing some really high prices, but margins are, as you can see, trending a little bit downwards there. And just touching on the U.S. a little bit, just because we do send a lot of pigs down to the U.S. and the markets are so intertwined. So interesting just to see hog inventories down in the U.S. as is their herd as a whole getting bigger, getting smaller as it reacts to consumer demand, right? So we saw it's about 73.8 million head in September, which is a little bit smaller from that time a year ago, but it is on the way up. So the herd is increasing as prices of pork is pretty high. So we're still seeing lots of optimism from hog producers, U.S. and Canada, that demand is there and margins are going to follow. So, and probably have to touch a little bit on African swine fever. As the map shows, it's in lots of Asian countries. Europe is starting to see a lot more impacts now, and I guess hitting a little bit closer to home. Was found in Dominican Republic and Haiti as well. So a little bit of a scare there because it did come across the ocean. And so, I think the industry is preparing for the impact. I think they've realized that they could slow it down, but I don't know if they can ever totally keep it out. So, as of obviously today, it's never been in Canada or the U.S., and all the efforts from the industry are just stopping that spread and slowing it down as much as it can. So, as I said, Canada and the U.S. markets are fairly intermingled. So if it gets into the U.S., almost guaranteed it's coming up to Canada shortly after that. So. So just talk about the cattle industry here. We'll look at a little bit of a market update. We are seeing the herd getting a bit smaller in Canada, and we'll take a little bit of a look at some feedlot margins as well. I think in general we're seeing some larger carcass weights as we're going through the year here. About 10 pounds higher for some steers. Probably part of that was last year we had a drought in the West, so weights were definitely down. And this year I think we've got better moisture, and so we're just putting more gain on those animals. So in conjunction with that, we're also seeing some fairly decent pricing. So fed steers, we're at a high of 182 per hundredweight in September. So that's roughly $24 higher than last year. So with increased weights, we're also seeing some increasing prices, and it's significantly above the 5-year average by almost $40. So So that's bodes well for the industry. I think we're going to see some more profit come back into that cattle side. But it is coming on the heels of last year, which I think we saw lots of animals and the herd as a general decrease. And kind of showing Manitoba, but also Canada, and probably focus more on the Canadian side. As of July, we're just seeing that trend, right? If you're looking at beef cows, that couple lines down there, we see the number of beef cows just continually getting a little bit smaller as the years go on. Also beef replacement heifers are shrinking. So, it takes a while for the industry to turn around. And when your replacements are lower, then it's just going to take a while, a couple of years to turn those numbers around and rebuild herds. And given some of the drought conditions that were here, then obviously we saw the industry getting a bit smaller and the herds getting smaller. So. And just looking at a little bit of feedlot margins, again, this is just based on some cash numbers and looking at that, for heifer calves and steer calves, it's seeing a little bit of red in there. So obviously some of those margins are getting tight, especially if you're buying in some expensive animals. But again, these are without, any sort of FX hedging and that sort of thing. So I think, going forward, when you look at those projected prices, we definitely can see some profit out there, into that May and June timeframe. So definitely some optimism as well. Looking at the wineries and the wine industry, I think the supply of grapes, and in particular in Ontario, was lacking again. They had a lack of rain, which was a big impact there, and roughly about 2/3 of the crop in Ontario compared to last year, which would probably be an abundant year. So that's definitely going to impact wine producers. Profitability again is getting a bit strained. I think margins are getting really compressed on that side from what we're seeing. So especially multiple years really starts to erode working capital, really starts to erode leverage, that sort of thing. So not great news for the industry when you couple that with labor shortages. Not uncommon and impacting the wine industry as well. So it's extremely difficult just to find labor for harvest or even throughout the season. And then, supply shortages on that supply chain, right? So inputs for packaging, processing, and just making wine are all in short supply. And so all those different things are kind of coming together, and it's kind of a tough time frame right now for the wine industry. If we look at the cannabis industry, I think again we're seeing some of the private companies are still struggling to find profits, even though sales are increasing. I think part of that was there was a big overproduction for a lot of these companies when they started, and so that's just impacted their margins because they've had to spend a bunch of money on product that they're just not selling at this point, right? So they're having to write down inventories, that sort of thing. I will say that the public companies on the other side seem to be finding more profits. So there is talk of do we need to standardize things, that sort of thing. Some of those debates going on in the industry, and of course there was some disruptions. There's a strike, by some workers working in the stores in BC, and then a cyber attack in Ontario on some of those stores. So those things all don't help the industry. So interesting that sales are increasing, demand is increasing, but profitability is still I think hard to come by at this point. And if we're looking at the food and beverage industry. Yeah, food prices, you know, are jumping up, you know, as high as 10.3% year over year. And that's some of the highest increases we've seen since the 80s. So I think, you know, lots of consumers out there are starting to change habits, starting to shop a little differently from that perspective. And so it really bodes on the industry that, you know, that those prices are jumping up, and therefore consumers are buying differently than they would have in the past. So obviously they're getting impacted by rising costs, you know, due to all the inflation that we were talking about at the beginning. And yeah, maintaining those margins are becoming harder. The trend is that consumers are choosing lower margin products over the higher margin ones, and so that mix of different products that a food and beverage company might be selling, if more sales are made up by those lower margin products, then it's just straining some of the profitability there. So I mean, the industry is still forecasted to grow into 2023 and beyond, but there are these challenges that they're dealing with right now. And with that, I think that's all I have. So back over to you, Vic.
Thank you, John. Your information was very informative. I hope interest rates don't go up to the 23% that I saw in the early 80s, as that would really have a negative effect on everything in the economy in Canada. We would like to thank everyone for participating in this webinar, and would encourage you to contact John or any of our farm management consulting practitioners directly with any specific agricultural questions. Any insolvency related questions should be directed to me or to any of our cross-Canada insolvency team. The appendix to today's presentation includes further information about MNP and our farm management consulting group. This webinar has been recorded and sent to all of you as you have requested to be added to our ag webinar distribution list, and will also be posted to our mnpdebt.ca website. Please feel free to forward the link to your colleagues and encourage them to contact me directly should they wish to be added to the distribution list. We look forward to your participation at our spring 2023 webinar, and we also look forward to hearing from you with any questions or comments you may have. Have a great winter, stay safe, and thank you for listening.